Hello everyone and welcome to our 7th webinar in a series of 10 looking at momentum studies today with Clive Lambert of FuturesTechs. Clive, are you with us?
Hello Chris, how are you doing?
Very well, thank you. Yourself?
Well, I think I've got a bit of man flu happening, but hopefully that won't affect the my presentation skills, as it were. We'll try
I'm
and
sure it
do the
won't, Clive.
professional thing and soldier on.
I know how serious man flu can be. It's terrible. I wish you better, and we look forward to hearing about momentum studies.
Okay, thanks very much. Okay, I'm going
Thank
to
you.
concentrate on 3 particular studies today, actually. I can't actually remember which order I put them in. I think we're going to look at MACD, and then the stochastic oscillator, and finish off looking at RSI. Yes, that is the order we're doing things in. So yeah, if I go quiet, that's because I'm having a cough and a splutter and a quick drink of water, but I'll try not to spread any germs. I think we're safe on this medium, aren't we? Hello everybody, nice to see you, and let's get cracking then. Where's our first slide? Let's have a look. Right, okay, so as I said last week when we looked at the very basic indicators, if you like, last week with respect to, and when we looked at moving averages and Bollinger Bands, which, you know, I think we're overlaying things onto the chart in order to try and give us some extra information about momentum. And these are just mathematical operations using the basic data set, and they're trying to give us further clues as to the momentum and the trend of the market. Some are trend following, some look for turning points within the trend. And again, I don't mind repeating myself on this one. It is a misconception that there's a bit of magic going on here and that you can find the holy grail to trading with these particular things. As far as I'm concerned, they have their strengths and weaknesses, which is what I tried to discuss last week with the moving averages and the Bollinger Bands stuff, and I'll do the same this week. I'll look at the different studies. I'll give you an idea of how they're constructed, because that itself allows you to have an understanding of what, you know, when they'll be good for you and when they may not be so good for you. And so, you know, that's what we'll do with each of the things we're looking at today. So yeah, strengths and weaknesses, I think I just said something about that. Okay, they're just another weapon in your arsenal. They don't replace any other technical tool. They're a great asset, they can be a great asset in confirming signals generated from the price chart mainly. And so, you know, so let's crack on with the first one, which is called the MACD, the Moving Average Convergence Divergence is what that stands for, and what it does is combines a couple of exponential moving averages of differing time periods. I don't know whether we really got into what the difference between a simple moving average and an exponential moving average last week. Quite simply, just without getting into it, getting too complicated, an exponential moving average is weighted, so the most recent price action has a bit more importance placed on it than something that happened in the past. Okay, so I think one of the weaknesses of a simple moving average is that as well as your latest piece of data, i.e. what happened yesterday or on the last candle or the last bar, is in the equation, also what's dropping off at the other end can have an effect on the calculation. Whereas the exponential moving average says we will place far more importance on what's just happened rather than what happened in the past, if you like. That means that they react a bit quicker. Okay, so there we have a 12-day exponential moving average on a chart, and I've stuck to a bit of an old favourite that we've used throughout this webinar series, and we've got the DAX daily up there. Okay, so that's the 12-day exponential moving average, and actually you can see just as an average on its own, if we were looking with respect to last week, did a very nice job of keeping you in that rally all the way up there if you'd just used it on its own. But we're using it right. I'm illustrating right now how we're getting MACD calculation. We'll also plot a 26-day exponential moving average on our chart, which is that pink or purple line that we have on our chart. And then the next one is opening up a separate box that's on the bottom of our chart, and that blue line on that extra box at the bottom is plotting the difference between those two lines. Okay, so what that actually does is when the market's trending strongly, the 12-day moving average will be kind of running towards it quicker than the 26-day exponential moving average. This is the shorter the moving average, the tighter it is to the trading range. And so the higher the reading of the difference, the more upside momentum there is, quite simply. That's what that's called, the lead line. We're adding something else to this though. We're adding another line on top of our indicator, and that red line on our chart that we've added there in this bottom window is a 9-day exponential moving average of the blue line. So we're smoothing we're taking the difference between two averages, and then we're smoothing that one more time, and we have a moving average of that difference. Okay. There is one little bit of extra information that are on the trading view charts that are supplied through the DF Markets platform, and that is this small histogram here, this red histogram, which is actually another graphical illustration of the distance between these two lines here. Okay, and so when they cross, like here and here and here, that histogram is at a reading of 0. Okay, so you can see the bumps in the histogram while it's above 0, and the troughs in the histogram while it's below 0. So it's always oscillating around that line whenever these lines are crossing. Okay, so that's the basic construction of the MACD. And the 9-day average that we apply on the top smooths the output generated from the MACD line and gives us what we call a signal line and a lead line. And that in itself, that leads us to giving us buy and sell signals. Okay, and the basic buy signal is generated when the lead line, that blue line, crosses above the signal line from below. And a sell signal is given when, and if the market stays in an upward trend, then those lines should stay in that order, the blue line above the red line. And then when the market turns over, they cross back over again. The lead line drops through the signal line to give a sell signal. So that is your basic signals right there on that chart. Okay, here we have the lines going downwards, and then we get a buy signal right here, and this is a sell signal here when the blue line drops through the red line. There are other signals on there. That's a sell signal there as well, and we've got a little bit of mess going on just after our initial buy signal here. So you can see actually that I've highlighted two signals on there, and it looks great that we're buying down here and we're selling up here. But as we, with that on that particular chart, there were a few little messy times as well and false signals. Okay, so straight away, I'm being straight with you. I'm not saying to you that here we have an infallible system that can make you millions or whatever. These they do give false signals at times. Sorry about the reality, it's just the way I work. And one of the other things that can happen with these signals is that they can suffer from lag, if you like. So we talked about this last week with moving averages, the fact that sometimes a moving average signal will come after the event, if you like, and will be a little bit late to the party. So that's something to watch out for, because that sell signal we got there came after that red candle there. So we actually got the sell signal here. It looks like it's very near to the highs, but it was actually after that red candle there. Somebody's asking on the questions, how about the time frame we use on the MACD? Yep, I can tell you that the time frame that I use is 12, 26, and 9, as we said. Okay, and we're looking at on the slides, we're looking at the daily chart. On this, I've just cut to a chart that I've got with all of the indicators we're going to look at today, and that's our 30-minute chart on the Australian dollar, which is just something that I grabbed up. So does that answer the question? I hope so. Let's get back to the slides. Where are we? We're here. Okay. So yeah, they're not perfect signals. Is there a better way of using these? Yes, I think so. What I like to look for is are those times when the indicator gives you something called a divergence compared to the price chart. Okay, and divergence is the name given to situations where the price and indicator are doing something slightly different to each other. They're moving in different directions. And generally divergences provide a reliable and sometimes preemptive sign of a reversal. For example, back to our DAX chart, market is travelling lower during this period. We're making lower highs and lower lows, yeah? That's a classic sort of downtrend type of behavior. But look at this indicator, look at the MACD. That was the bottom of the MACD right there when the market was here. And then MACD started travelling higher while the price chart continued to travel lower. And that is a bullish or positive divergence setup, if you like. And that says to us, basically, if we think about what we've seen already with respect to how this is constructed, that is the momentum study saying, yes, we are traveling lower during this period here, but we are losing downside momentum. In other words, we're going down, but we're not going down at the same sort of pace as we were a couple of weeks or a couple of months earlier. And that in itself is a clue, if you like, that maybe the downside momentum is slowing and that we may be looking at, we may have to consider the idea that the market is on the, is going to turn soon, because we are running out of steam as far as moving lower is concerned. And so that, for me, is where momentum studies and indicators and everything we're going to look at today and these, all of these studies that you put in a box at the bottom of the screen, most of them, if they're momentum-based studies, this is the bit, as far as I'm concerned, where you can get some value from them. Divergence, okay, when the indicator is doing something different to the price chart. Is everybody happy with the idea of divergence there? And that's a positive or a bullish divergence. Let me try and show you an example of the opposite, which is a bearish divergence. Let's see if we can, how do we get another chart up here? New chart, what's that? Indicators, fundamentals. Let's have a look. Bear with me a second, people. Let's see if I can find anything on this particular chart. Let's change the time frame. Let's change it to a daily. Let's see what we get. I'd like one on the MACD that I can show you. There we go. Right, okay, so this is the daily Aussie dollar, and this is back in March and April, and there we were going up there, higher highs and higher lows, and there, right there, on that high there is where the MACD topped out. But we went on to make a new high there and another new high here. Okay, have I got my the cursors I want this time? Okay, we made a new high here, but the MACD made a lower high, and then it gave a sell signal here. blue line dropping through the red line, okay, which is somewhere around here. And there we go, we've got to move lower. Okay, so that is an example of a bearish divergence. The price chart is making new highs. The MACD is disagreeing and saying, no, actually, we're making new highs, but we're not doing it with the kind of momentum we were earlier on in a week or two or a month or two before. So there again, we have that sort of setup of divergence, and that's something to look out for. And that's where, for me, a momentum study can help you to to find trading signals on your charts. Have we got anything else there? We've got on that particular. On that occurrence, some sort of a evening star going on there with respect to that. But yeah, these downward sloping indicators are telling us something else. They're telling us, this thing is actually trending. It's running out of steam to the upside. Okay, so that's MACD, and has introduced the idea of divergence, of bearish and bullish divergence. Now let's look at another indicator that's in a similar vein, but is actually a bit more shorter term as far as the signals it gives are concerned. And that is the slow stochastic oscillator, developed in the late 50s by George Lane. It calculates the relative position of a market's closing price within the trading range of that market over a set number of past periods. Okay, so it's actually measuring the capacity of the buyers, if you like, to close the day at or near the top of the recent range. Again, it's designed to try and look for turning points in price movement, whereas the MACD is more of a trend following tool and trying to keep you in a move, if you like. And with stochastics, we're introducing the idea of markets being overbought or oversold, i.e. the market is getting to extreme levels that are unsustainable. And that in itself can be rather dangerous, but we will discuss that a little bit more as we go through the and you know, when we look at the end, if you like. So it'll express the most recent closing price as a percentage of the recent range. Okay, and so we move from 0 to 100%. Let's have a look at how that works. And I'm just going to do a very simple sort of to show you the calculation of a 5-day stochastic. We've got 5 days worth of price action here. This is the first day here. It's red, and we 60 was the high of the 5 days on this chart. On day 4 we sell off down to 50, and on day 5 we open higher and we close at 55. And I've got a slightly wonky I'm not going to worry about it too much, you wouldn't even notice. So, and this is the calculation for the MACD, for the slow stochastics, and if we put in our numbers here, we see that a mid-range close gives you a stochastic reading of 50%. Okay, so it's saying that the latest close is exactly at the halfway point of that 5-day range. So that would give you a stochastic reading of 50. It's a moving thing, just like a moving average. Okay, if we have a new day where we and so we're talking about day 6 now in inverted commas, and up we go to here to close, and we lose the first day. So we're just looking at the last 5 days. We're losing a day off the end as we had a new day on this end. And now the trading range over the 5 days that we've got in front of us now is 8, because it's 50 to 58, and we close at 58. And again, if we do the maths using the stochastic calculation here, we come out with a reading of 100%. We have closed at the highest point of that that 5-day range. Okay, so you can see how this is calculated, hopefully, and that is the raw reading of the fast stochastic. Okay, now let me just show you, let me just show you something on the hopefully I can show you this on this one here. Okay, if we do if we change this, take out the, hang on, let's just change that to, smooth that to 1. Okay, that blue line is the fast stochastic. George Lane found that this, I mean, and as you can see, there's, yeah, we're not getting any real clarity of signals here, okay? It's all a little bit jumpy and a little bit messy, so he wasn't too happy with that, didn't really like what was going on there, and so did some smoothing, moving average style smoothing, okay, and came up with 2 lines, the percent K line and the percent D line. And it's a similar kind of thing going on here as we've got in the MACD, right? But we're looking down here. Let's just make the stochastics the big one so we can just concentrate on that for the minute, okay? Let's just mess around with these. Where's my, come on you. That's it. Okay. So we smoothed it out a little bit in order to try and reduce the number of signals and to make the signals that we do get a little bit more reliable. So we start off with that raw reading, as I've just shown you on the slides there, and then we smooth it with a 3-day average, and then we smooth it one more with a 3-day average to give you this red line. Okay, and that gives you sell signals, again similar to MACD, where it's the crossing of the lines that give you the signals, and it gives you buy signals when the blue line, the faster line, moves back above the red line. Okay, so there's our basic signals there. Sell signal, buy signal, sell signal, buy signal. You can see if you compare that to let's get rid of RSI. If you compare that to the MACD that we just looked at before, we're getting more signals from the stochastics, yeah. But the other thing that we've got on the stochastic oscillator, and this can trip people up at times. I think we can probably go back to the slides to talk about this. No, I haven't included it on the slides, so I better get on and do it now. Actually, I can show you that with the RSI, or shall I? How shall I do this? Let's go back to here. Sorry about this, people. I've just messed myself up a little bit, but we will crack on with this. Right. MACD can go as high as you like or as low as you like, depending on if the market continues to trend. Those lines will continue to blow out and continue to get higher and higher readings, if you like. Slow stochastics cannot go above 100. And so what slow stochastics introduces into the equation is this idea of markets being overbought or oversold. And what that says to you is here, right, that purple, that very small shaded region here is our mid-range. Anything above a reading of 80 on the stochastics, okay, whenever stochastics goes above 80, both of those lines, then you are in overbought territory, okay? And every time we drop below 20, which is the bottom line of this, the market is deemed to be moving into oversold territory. Now, if you read the textbooks on these things, they do not say that you should short a market that goes into overbought territory and you should go long of a market that goes into oversold territory. It doesn't tell you that. Quite simply, if something like this stochastic goes into overbought territory, like it does here, it is, if you like, the first warning sign that maybe things may be overheating to the upside. When you get the sell signal, and an actual sell signal on this is the lines crossing and then the market coming out of overbought. Okay, that's the actual textbook from George Lane in the 50s and 60s signal for that. And look, you can actually see from this why it would be dangerous to say, oh, stochastic is oversold, so therefore I'm going to buy. Because stochastic got into oversold here on the 3rd of May, which I think was that candle there. Okay, it was right around here that it said that stochastic told you this was oversold, and it kept going down. Okay. The buy signal came here, which is here. Now that's much more like it, isn't it? Okay, and the buy signal came because the lines crossed and then we came out of oversold. And that happened right around here, and that was a much better combination of events, if you like, with respect to giving you a signal. And so again, it's really important with these things to actually wait for the proper signal to be given, and to read the books, and to make sure that that people that you're using it the way it was intended, because you can really tie yourself in knots. I mean, imagine if we put our old friend Bitcoin up here, we would let's do this just anyway, shall we? Let's change that. I wonder if I can just do this by changing this to everybody's favorite. No, it's not going to work, is it? I haven't got it on here. Let's see.
Clive, I think you have a spread betting demo there, Clive, and Bitcoin is only available on CFD.
Okay, thanks, Chris. No problem at all. I can show it to people on another chart. So let's have a look. Where is this Bitcoin thingy that everybody keeps banging on about? I can drag across right. So actually, right, this is my on my TradingView account. This is my Bitcoin chart, and I was looking at these long-legged doji patterns. Do you remember when we were doing candles? I was looking at these long-legged doji patterns back at the end of November, and thinking, oh, that could be the high. Is the bubble burst? Well, no, clearly not. Off we go again. Although 17,000 does seem to be causing the bulls some troubles now in that one. But if we were to add, let's grab this and go, we will insert an indicator, and we will insert MACD there, and we will insert Stochastics here, and we will close that down, and we will try and make these lines a bit bigger so everybody can see. Let's go, and got some strange colors going on here. Format, let's get you up there and you up there, so we are making things a little bit more clear. So we've got a buy signal from the MACD. Let's get rid of that. Got a buy signal from the MACD right around here. Okay, so that was and that's stayed as a buy ever since, and I'm sure if we were to squeeze this up, that's been in buy mode for a while. Yes, absolutely. Look, it was a buy signal here, sell signal here, buy signal here, sell signal there, buy signal here. Stochastics, but the point I want to make, right, is Stochastics has been in overbought for long periods of time. All of this period here, from the end of September right up to the 22nd of October, Stochastics was overbought. Okay, then we dipped down to oversold there actually, but then straight back into overbought, and pretty much staying up there ever since. Okay, so selling something because it's overbought, that is a classic example of how that really isn't a very sensible strategy whatsoever. So back to the slides. Where are we? Okay, slow stochastics. Right, okay, so yes, that's the slow stochastics. That's what it looks like. That's the signals it gives. It's as I say, it is a speeded up version of the MACD indicator, but it does introduce that extra layer of overbought and oversold into the equation. Last one we're going to look at today is the RSI, and that isn't what you get. It's not repetitive strain injury for your eyes for looking at too many charts, although sometimes I think I feel like that. RSI actually stands for the Relative Strength Index, and is one of my personal favorite indicators. It was again developed in the 70s. A lot of these indicators were developed in the 50s, 60s and 70s by some very clever mathematician type people. And actually one thing to say about that is that the default settings that they use, i.e. this 9-day Yeah, 12-day, 26-day, 9-day for the MACD, and the default setting for the stochastics is a 14-day range that you're using, and then those smoothings at 3 periods and 3 periods. The RSI uses generally a 14-day period as its default setting. You can play around with them, and I'll show you how to do that in a minute, actually. Yeah, but they were developed by these guys, and they were back tested across a whole range of markets over a whole, a lot of time periods, and they have generally stood up to be fairly robust, if you like. And I don't see too many people playing around with these, although you can optimize them on, if you have a machine that can fiddle around with settings and find the best ones, then great, that's something you can do. But as I say, the industry's tended to have stuck to the original default settings. What the RSI does differently to stochastics is it basically gives you a ratio. It adds up the total gains on the up days and divides them by the total losses on the down days over a 14-day period. And again, it introduces this idea of markets being overbought if we get too high, oversold if we get too low. But again, you have to wait for the proper signal before, otherwise you can, and it's not sensible to do this to sell a market that's overbought, or to just go long of something because it's oversold. And there is the RSI. And again, so we have these zones above and below the market where the market is deemed to be overbought if we have a reading on the RSI of 70. I've sometimes seen people use 75, and the oversold is a reading below 30, although again I quite often see people using 25 and 75 as these zones, and you can change it. Okay, when I say you can change it, let's do exactly that right now, shall we, with our Aussie dollar chart. So let's get rid of the stochastics, and let's now concentrate on the RSI. Okay, and we shall click on that RSI. We can format the chart. I'm pretty sure that we can have, yes, look, here we go, upper limit, change that to 75, lower limit, change it to 25, press OK, and now our lines are further away. In fact, if we're looking at this particular chart, we never actually get into overbought or oversold territories. So in this instance, we would probably, if we want to try and get some value from this, change that back to 70 and 30, and now we do get times where the market goes into overbought territory and where it touches oversold territory down here. Okay, so that's the RSI. Let's just go back to the slides for a minute so I can make sure that I'm not just bimbling away and not sticking to my script, as it were. Overbought and oversold RSI, yes, that's fine. Divergence, again, it's a thing, it's something that I like looking out for with momentum studies, and with RSI in particular, is this idea of divergence, and something that Wells Wilder was keen on when he was formulating the RSI, was trying to quantify, trying to actually put, have something where people can press a button on these signals that created from the divergence. Because actually that slide we looked at for MACD earlier, yes, we've got a divergence there, but no, it didn't tell you when to buy or sell. Whereas the RSI has this, Wells Wilder developed a system, and it was a failure swing system. And we can see on this chart that we have, let's start, come here, right, we have two highs on the price chart here, and then a new high here, whereas the RSI has made lower highs. And what Wells Wilder said was, draw a line underneath those two peaks on the RSI, and when we break below that line, you get a sell signal, and that happened after that second red candle there. Okay, so that was a bit quicker. It was all, you know, we're very soon after the top, we're getting this RSI top failure swing sell signal. The opposite to that is a bottom failure swing. Price makes a new low. The indicator is making higher lows. Look. Okay, well, what's the high between those two higher lows on the indicator? And next step is when we go above there, thunder flashes, we get a buy signal. And on that chart, we got that buy signal, as I say, after that second green candle. So that is the failure swing signal generating tool, if you like. And again, if we go back to our charts and we look at the DAX, I think we want to look at. Let's see whether we got anything on that. And are we up to date on this? Is this the latest chart? Right, did we get the signal there? I'm trying to remember. No, there wasn't one on that, but there was one on the Dow. Can we get the Dow? I'll tell you what, I'm going to put it in my charting system just to make it a bit easier. We have that sort of set up at the moment on Dow futures, right? Lower lows for the indicator, lower highs for the indicator, whilst price is making a new high. But beware, because we had a very similar setup here as well. Okay, and I've just moved that chart to the right, and this is the price action on the Dow futures right up until the middle of November, and that gave a top failure swing sell signal here. Look, okay, it gave it right here, 8th of November. It said this is a sell. Okay, so right here. Now that's pretty quick, and it didn't work. Okay, it didn't work at all. We went on to make new highs, so that one didn't work. But it does appear still that we have this. We're still making lower highs on the momentum studies. So it's still saying that momentum, upside momentum, was at its greatest here in late October, and what we've seen since is, you know, this is, although we've surged to new highs, it is not with the sort of momentum that we saw back there. So that's an interesting thing to be keeping an eye out on. Right, so you can fiddle around, as I've just showed you previously, you can fiddle around with the parameters of where overbought and oversold is, and something I've seen people do, for example, is if you're in a rampant bullish trend, then they move oversold to 40 and overbought to 80, so that it can so that it's more in line, if you like, with the overall market conditions. Another way I've seen people use RSI quite often is just quite simply as an extra tick box to say, is this trend bullish or bearish? Okay, and the RSI can add its tick to that question, you know, that by quite simply saying, is the RSI above 50 or is it below 50? If the RSI is above 50 and rising, and the MACD, both lines are rising, and we've had a buy signal, then they're things that say, tick, we're in a bullish trend. Tick, we're in a bullish trend. And so if you're looking to build a system that's maybe buying dips in a bullish trend, you could add to your system, is the RSI above 50 on, you know, on the daily? Is it above 50 on the weekly? So it's just conditions, if you like, for that you need to satisfy before you put it on a trade. You can use these indicators as those extra layers of confirmation, if you like, to make sure that your trade is in line with the trend. That's the end of the slides, and so I'm very happy to answer any questions that anybody has, and I'm very happy to go back to our live charts here and try and have a little look at where's my stochastics gone? I think I've lost the stochastic oscillator on that one. So yeah, I mean, please, anybody that's got any questions, please shout.
Clive?
Hello, sir.
Hi there. While we wait a few minutes, hopefully, for some questions to come in, do you want to tell the guys about your generous free trial offer again that you'll do for DF Markets clients?
Right. Yeah, can do. I am very happy to. We're running. When's our last date, Chris, for these webinars?
Oh, surely.
Because we're on our 7th, and I think we decided to run 10, didn't we?
Yeah, the first one back's the 9th of Jan.
Okay,
so
yeah, we're having our little Christmas break now, aren't we? Me and Chris have worked very hard this year, and we've decided that it's time to have a little bit of a rest. So we're going to be back with these webinars in January with 3 more, aren't we? So the
Indeed.
9th. And then the 16th and the 23rd, I suppose, yeah?
Yes, yeah.
And the 23rd, I think, my plan for the 23rd is to not actually come armed with much and make it quite a sort of open Q&A type of thing where we can try and bring everything together, if you like, and have a bit of an open forum, if you like. In the meantime, this is my website, and if you go to Individual Trader, and press trial, and then you fill out this, and it says you'll get access for 1 week. If you fill that, I can't seem to scroll here. What's going on? Come here, you. If you scroll down on that form, which I can't do, why can't I do that? This is all starting to get rather annoying. Let's do it on a different browser. 2 secs. Bear with me. Time for a different browser. FuturesTechs. Okay, let's see if we can do it on this Individual Trader trial. Scroll down, and it says, where did you hear about us? And if you put DF Markets in there, right there, then our people will pick that up, and we will extend your trial until the 23rd of January. Bearing in mind that next week, around the same time, I will be on my first break, if you like. I will be having a break off for Christmas, so there will be a break in the service. But happy to extend that trial into January for anybody. So we do have a question, and it is. Let's have a look. You answered this question with the entry signal for the RSI indicator, but for the MACD, a divergence shows an impending reversal event that may occur. It doesn't show when it will happen. Absolutely true. What additional event would you provide with your entry signal for MACD? Yeah, exactly. I did make that point in the thing that MACD does not give you the actual, the RSI does attempt to give you a definitive signal. The MACD doesn't actually provide that to you. What other event? That's very much a sort of what I've got planned for that sort of second for that last seminar that we're going to do. What I'd like to do with that is hang on, let me just get that chart up again. Yeah, that'll do. Because, as I say, well, one of the things I've been sort of trying to sort of develop with you guys throughout the series is the idea of having a series of having a checkbox thing, if you like, where technical analysis says to you, right, yes, 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 and if you tick 3 or 4 boxes, then you have a signal. And so MACD, you could potentially, one of those things could, the MACD doesn't give you a signal in itself, but it does potentially it can be an extra tick, if you like. So you could use the price, and I will always favour the idea of using the price chart as the key thing to give you the signals. So if we insert an indicator here, we get the MACD up here, we add that in, and then we've got so we've got a bit of divergence here when we hit this bottom, this 5-minute chart actually. Okay, a bit of divergence there, and we've got 2 similar lows there, and so the sort of thing you could look for is to say, right, if we break, there's a resistance level there, and there's probably another resistance. We found some resistance around here. Let's put another horizontal line in there, right here, and then another horizontal line. Bear with me, people. Right, okay. When we got this small setup overnight, I think it would have been overnight, wouldn't it, on the Aussie dollar? and I must admit I've got to put my hands up. I am doing a bit of a hindsight here, because it's the chart that's just come up in front of me. Just try and make these lines a bit thicker so we can try and get an idea. Okay, and bang. Okay, there's the small bullish divergence. The MACD is saying to us, yes, that's a potential double bottom. We get a buy signal there when we break above there, right here. We get another buy signal here when we break that resistance, and another buy, and as we tick off the resistance levels, you could enter long trades. And actually now on this chart we've got a bearish divergence set up, which would, potentially, which means you should be looking to maybe exit positions, any long positions, and you can start putting in things like an uptrend line there. That's nice, isn't it? Look at that baby. Okay, there's a nice support line there, and again, let's make it thicker, make it a different color, shall we? This is the sort of thing that I'd like to play around with on that last seminar. Is these ideas where you say, okay, if we got long here, and here, then we're seeing some evidence that it's time to get out now, and especially if we break that uptrend line, then there's another thing that says to you to get out. So yeah, that's what I'm saying, is combine things together. But combining the MACD gave us the hint that we've got a buy set up, and then breaking the resistance levels was confirming this and giving us buy signals, and now we're going the other way. We're getting the hint that may be that's a weak high, if you like, and we're coming back down and we're testing things like this support line now. Hopefully that gives you some sort of flavour of how you can use these. Yes, Chris?
Can we look at everyone's favourite, the DAX, please? And can we see if the charts are pointing to a Santa rally, or is that just all a myth?
The old Santa rally in the DAX, yeah. Okay, and let's go to a daily time frame. Now, I think we say it's the old favourite, and we did have the Fibonacci, Mr. Fibonacci, telling us that we have this strong support. Let's just click on this and play around with it. I don't like these colours very much. I don't like the 23.68, and I do like to extend that to extend the line. So let's get that where we want it. Do you remember we were talking about 12.896, and it held on dips? We dipped through it, we came back, we dipped through it, we came back, we dipped through it, we came back. There we keep finding we keep finding buyers when we dip through that line there. Okay, now the problem is 13,200, 13,200, 13,200. We don't seem to be able to get through 13,200. And so when we do, yes, there you go, you can have your Santa rally in the DAX as soon as we see a close above 13,200, and not until then. One thing to bear in mind for the DAX is that we are very close to the expiry of the December futures. Okay, it's Friday, and so the market, the futures trading community, if you like, and the anyone involved in equity markets will have that on their minds. The fact that we are getting close to what's known as the annual, the quarterly rollover, or the expiration of the futures. That can see markets sticking around round numbers, which is an interesting sort of phenomenon, if you like, with respect to equity indices, because the options are all based on round numbers. You can quite often see the markets sticking around round numbers in the run up to that options expiration and futures expiration. And the other thing that I would actually say as well, just as a bit of as an anecdote, is that you can often see some volatility around the time of the actual expiration, which is on Friday morning. So be careful on Friday morning if you're trading equity indices. And on that note, I think we shall say that we'll call it a day. And I've just seen somebody asking about the trial. I will get on that for you, and I will get that sorted for you. Whoever asked that last question. Thanks very much for listening, guys, and have a really good Christmas, and see you all in the new year.
Clive, thank you very much. Again, thank you everyone for attending today. If you've got any questions about the products, markets or services that we do offer, please do contact us through the website, through the live chat function, or send us an email or give us a call. We're always here to answer any questions we can. Clive, thanks once again. Have a great Christmas, and look forward to the webinar on the 9th in the new year. Thank you very much.
Cheers, guys. See you later. Thanks, Chris.
Bye-bye.